Good morning and welcome to another Venturi Market Update. We're excited today to have a special guest with us. We have Alejandra Grindal from Ned Davis Research. Alejandra has spent 15 years at Ned Davis, where she has been focused on global labor trends and demographics. Alejandra is going to walk us through the implications of an increasing governmental role in the economy and the aftermath as we get beyond COVID. So welcome, Alejandra, and thanks.
Great. Thank you so much, Chris. Thank you, everyone, for joining me today. As Chris mentioned, I'm going to discuss the increased role of government on the economy. This has been a hot topic, especially in light of the recent pandemic and the ongoing pandemic. So my presentation is divided into three main sections. I start off first with just looking at the recent global trends. I'm not just going to talk about the US, I want to talk about the rest of the world. Sort of make some comparisons versus now during the COVID pandemic compared to maybe past cycles, what makes now a little different. And then the middle of the presentation, I want to discuss, well, what are the consequences of all this government spending? And ultimately, is this something even we need to worry about? And what are the reasons for that? And then in the final segment of the presentation, I'd like to spend some time discussing just the long-term view. Perhaps this stimulus could be a symptom of something much bigger. What's the cause of all this stimulus? And ultimately, what should we expect going forward? So hopefully I'll go through several time frames. So this is just our standard marketing slide for Ned Davis Research. We cover investment ideas through various facets and various forms of research. I'm the macroeconomist, so this is going to be more macro-oriented, but realize we do have a pretty broad breadth and approach to our research overall. But just focusing on this very first slide, I don't think it's any surprise when I tell you that the global economy has really experienced its worst recession in recent history. And by recent history, very likely since the post-war era. So these right here are projections of real GDP growth for 2020 from the IMF among some of the world's largest economies. And these declines are, just unprecedented. We haven't seen these in a really long time. Led by, say, Italy, France, UK, so Europe expected to have larger declines. China may eke out a little bit of a gain this year, but at around 1%. This is nothing like what China has been used to over the past few decades. One unique characteristic of this recession, I mean, there's a lot of reasons why it's unique, but one very unique characteristic is even though it was very, very deep as a recession, it's been actually fairly quick. In fact, we've been calling an end to the global recession late Q2, early Q3. Some of the European countries, because they're going back into lockdown, could see a bit of a double dip. But for the most part, it was very deep, but also very short. So to kind of think of the reasons as to why that happened, I would say there's two in particular, or two main ones. The first one is just sort of the obvious one is if you have most of the world going to a complete stop, shutting down, nothing functioning, schools closed, businesses closed, and then you reopen, even if you reopen a tiny bit, you are going to get a rebound in economic activity. So mathematically, we knew that was going to happen. But the other major driver, which of course is the topic of this presentation, is massive fiscal stimulus. And I think there were a lot of unique characteristics of the stimulus. Not only was it very large, but it also happened very quickly. Usually when we have recessions, it takes a while for governments to agree, who should we stimulate to, at what time should we do it? But in this case, governments all over the world were able to unify and, realize there's a bad guy. It's a pandemic. We could all line up behind that. So the stimulus happened very, very quickly. In fact, pretty much it was announced within the first months of the recession. So what I'm showing in this chart right here is a comparison between the fiscal policy response among various economies to COVID-19. That's in the blue bar, and then the orange bar, just for sake of comparison, the global financial crisis, which at the time we thought was going to be was the worst recession in the post-war era. And you can see, I mean, the numbers are absolutely off the charts for many parts of the developed world. And the forms of stimulus were actually somewhat similar among different countries. Lifelines to businesses, whether it be through loans or grants, direct checks to households. In fact, you may have seen this stat for the US that disposable income actually increased during the recession because of direct checks to households. We saw similar trends in Canada, Japan, Australia. So very different from what you see in past crises. Also enhanced unemployment as well as furlough schemes. You'll notice you'll see the larger exponential jumps in Europe as well as Japan. Although in that case, a lot of the reason the number looks big is because these are loans to small, medium, even large businesses. So at one point they would need to be paid back. If you look more at the US and Canada, it tended to be more grants. So that wasn't necessarily money that has to be paid back. So the net amount is still quite high. These countries tend to have, more automatic stabilizers. So the European countries, so they do have a little more built into the system. But either or, you just cannot deny that the stimulus is significantly higher and exponentially higher than it was during the global financial crisis. In terms of the market impact, if you look at global equities, US equities, they absolutely loved this stimulus. And even if you look at market action over the past few weeks, or even more than that, a couple of months, it's often been in response to whether there's going to be more stimulus or whether it's going to be delayed. But just to kind of give you a depiction of it right here, what we're showing right here was an indicator we created looking at stimulus information from Oxford University. And so what we're doing in this bottom clip is we're measuring the breadth of government support to households by country. And as you can see, this number just shot up in mid-March. And since then, we've been at roughly 96% of the world's major economies providing some sort of fiscal support to households. And you look at this top clip right here, this is global equities. And you could even argue that the fiscal stimulus had somewhat of a leading tendency to the bottom in markets. Markets were really happy by this, and it did help fuel a lot of upside so far this year anyway. So definitely justified. However, one consequence, if you spend a whole lot right now, it will add to your cumulative debt. So if you look at this chart right here, this is looking at government debt as a share of GDP. So, good way to calibrate it by country and by history. And we're looking at it for some of the world's largest economies, especially the ones that I showed you previously that engaged in a lot of fiscal stimulus. And, you'll see countries like the US and Japan, they will see their fiscal or overall government debt as a share of GDP rise by about 30 percentage points in just 1 year. I mean, this is unprecedented. In the case of UK and Eurozone, still some pretty big jumps, about 20 percentage points. So very, very big numbers. So as I promised at the beginning of the presentation, I wanted to discuss, well, what are the consequences? Should we even worry about the fact that we have higher government debt? And so just to kind of give you a little bit of a primer on it, if you see the chart on the left, this is a common framework that we use in macroeconomics, the ISLM curves. If any of you took undergraduate macroeconomics, I hope I'm not bringing back any bad memories of these curves and being like, I left economics because of these. These are driving me crazy. But it's strictly for explanation purposes. But if you look at the LM curve right there, ultimately that's measuring the liquidity preference. It's driven by central bank policy, as well as how banks ultimately, through the fractional reserve banking system, can put liquidity out in the system. And then the IS curve reflects the investment savings curve. So this can be, sort of the demand for goods and services. So this can be shifted by, government spending, which is obviously the context of what we're talking about today, but also consumption and investment. So ultimately, the way this framework works is holding all else constant. So that's the key word. That's the hint I'm giving you there. Holding all else constant. Whenever you have an increase in government spending, it leads to a rightward shift in the IS curve. And ultimately, you get higher interest rates. So that's ultimately the consequence, right? Are the higher interest rates. And, what are the issues with that? What are the consequences? So I list a few right here on the right side. One of the first ones that comes out is this notion of crowding out of private investment. So if governments spend so much and they drive up interest rates and makes it more costly for private businesses to borrow, and they're crowded out of the industry. And the general perception is that private industry makes better use of loanable funds, makes better use of investment decisions than the government does. So we would prefer to put more hands in them as opposed to directly to the government. And so by the government sort of, taking that role, it crowds out private investment. So, that's one major consequence that comes out. It also increases the cost of further government spending. So let's just say, we decide to engage in fiscal discipline now. Well, another recession is going to be inevitable. It's going to happen sometime in the future, and the government's going to have to step in and support those that are negatively impacted by that. And if interest rates are higher, it's going to cost them a lot more to do that. At the same time, if you look at what the US government spends most of its money on, it's Social Security and Medicare, those entitlements, which are kind of here to stay, and they're getting more expensive. Even if we don't make them more generous, they're getting more expensive. Medical care prices are going up, and more people are getting older than in the past. So that cost is going to go up. Government's going to have to spend for it, at least for the time being. They're promising to, and that in turn will make it more costly if interest rates are higher. And then, within your budget picture, your percentage of total spending will go higher toward interest rate expenditures, just to pay off that past debt. So again, you're putting a bigger share into that. And then perhaps in a worst case scenario, if the government spends a lot and it's becoming unattainable, then those people who buy the treasuries, whether it be foreigners or domestic, they'll lose confidence in the US government. And that will in turn drive interest rates higher and then create a feedback loop to all these other negative consequences I mentioned before. So, ultimately, in a nutshell, that's the issue with very high government debt. Interestingly, though, that relationship has actually broken down over the past decade or so. So if you look at this chart right here, what we're looking at is just the correlation between interest rates and federal government spending. And over the past 10 years or so, hasn't really mattered. The government has been able to spend more, and interest rates really haven't reacted. And I think ultimately the question behind this, and again, I'll take you back to those ISLM curves that may bring you nightmares, is that we're seeing that increase in government spending, which is shifting the IS curve to the right. But there's a lot of other things that are going on at the same time that are shifting the IS curve to the left, or shifting that LM curve to the right, that's keeping interest rates lower. And so ultimately the takeaway for now, as well as I would say the next few, maybe 5 years or the near future, is we just have more fiscal space. And so I'll discuss those in the next few pages. So, in terms of this high government spending, do we think it's going to be an issue anytime in the near term? Probably not. And I'll show you the reasons why, as well as perhaps discuss reasons for concern. So if we look at this next slide right here, one reason we haven't seen a huge surge in interest rates is because we have a new entity, not so new for Japan, but new for other parts of the world, and a new entity that is buying a lot of this government debt and these treasuries, and that's central banks. So what this chart right here is looking at is it's looking at central bank government bond holdings as a percentage of total government debt. And you can see how that number, especially this year, has surged for a lot of countries. In the case of Japan, it's been rising for quite some time. In fact, they're number one at roughly almost 50% of total debt are they holding, if you look at it with respect to total government debt. Europe isn't far behind, nor is the Bank of England. Bank of Canada, the Fed is a little lower, but they've seen a pretty big spike up so far this year. So, one is you have a big buyer of the debt out there that's able to keep interest rates fairly low. And most of these central banks have promised to continue to buy this debt going forward, which will also keep yields in check in the near term. Another potential argument for why we haven't seen, over the past few years especially, why we haven't seen such a surge in interest rates is that, maybe there's just not that much demand from the private sector. So they're not crowding up that loanable funds market. And that can often happen after global financial crises and when debt levels are very high. So when debt levels are very high and nominal growth is pretty low, you don't have an incentive to want to borrow more. So while you're getting that upward interest rate pressure from the government borrowing more, you're getting the downward pressure from the private sector. So that could be something that's potentially balancing that out. Another driver of why interest rates have remained low and likely will continue to be low, at least in the long term, is also high demand from foreigners. A lot of foreigners believe in the value of the treasuries. They think it's a really good store of value, safe place to go. And as you can see right here, you have countries with very high saving rates in other parts of the world, particularly China and Japan, and they own a great deal of treasuries. In fact, each of those countries owns over $1 trillion worth of US treasuries. So again, another factor that has allowed that relationship between interest rates and debt sort of to break down. And I think the final major argument is, well, what's the alternative? Right? Just in the near term or in the meantime, there's just not much of an alternative to the security offered by advanced economy debt, and for that matter, the dollar. And countries all over the world hold a lot of it. So if you look at this chart right here, this is looking at foreign exchange reserves by currency as a share of total global reserves. And this is, if you look at this very top clip, the dollar reigns. In fact, 2/3 of total global foreign exchange reserves are held in US dollars. So very, very high number. So let's just say all of these savers around the world lose confidence in treasuries and they're like, well, what's the next country in line? Well, it's the euro, right? Well, they're doing the same thing we are. So, it's not like you can put a lot of confidence in there. And then there's always ongoing concerns. Will the euro even exist in the long term? So, they're number 2 at 22%. After that, it's the Japanese yen. Again, they're doing exponentially more government spending as a share of GDP than we are. And then after that, it's the pound sterling, which has the debt issues like we do, as well as, Brexit. So, it's just that there isn't really a great alternative out there. And so that buys us quite a bit of time to be able to get away with this greater fiscal space. There could potentially be alternatives in the long term. I just don't see that change happening anytime soon. One particular alternative that's gained a lot of popularity recently is cryptocurrency. Like any sort of fiat currency, it doesn't really have intrinsic value. It's the value that we put into it. I don't think so that's one reason it's not a viable alternative in the near term. It's also very volatile. It's not a good medium of exchange, but it is gaining traction. So much to the point that a lot of central banks, particularly in Europe, so the Bank of England and the ECB, are now sort of researching having their own digital currency because they know this is probably going to be some changes going forward. So again, I don't see this becoming a huge issue anytime in the near term, but long term, it could be an alternative. Gold is also always an alternative, but there's just not enough out there to be able to, satisfy the size of the dollar market. And then, another alternative, which some people don't like to hear, but could potentially happen, is the Chinese yuan. If you look at the most actively traded currencies, it's usually ranked by economic size or has some sort of variation with economic size. And less than 10 years from now, China's probably going to be the world's largest economy. Now, it takes some time for that to shift, but it could potentially happen. And I think that's what China would prefer. I don't know I doubt it'll happen anytime soon. It's very hard to make these changes over short periods of time, but also China has somewhat of a pegged currency or a fixed currency. So it's really hard to make that a major foreign exchange reserve when it's not a floating currency. But the alternatives are out there. Take a while to change, but they are out there. And then just a quick view on inflation. Does all of this massive fiscal spending lead to higher inflation? Well, at least historically, it actually doesn't. And the reason for that is usually when governments engage in a lot of fiscal spending, it's during recessions, right? I mean, that's when they come in to help. So you'll notice by these shaded areas right here, these reflect US identified recessions. So usually when the government increases spending, they do it during recessions. And usually when you're in recession, aggregate demand is really weak. and holding all else constant, that tends to put downward pressure on inflation. In fact, it tends to be disinflationary. So that's why when deficits are large, we do tend to see weak inflation pressures. And when you look at this recession in particular, even though we got that quick bounce back, getting back to pre-COVID levels is going to take quite a bit of time. This isn't something that's going to happen overnight. I think a lot of the way we function day to day has changed a lot, and things really aren't going to get back to normal until there's widespread, herd immunity, whether it comes through a virus or whether it comes through naturally. And that's not going to happen for some time. In fact, at the earliest, we don't expect global GDP levels to get back to pre-COVID levels until the end of 2022. So aggregate demand should remain somewhat constrained in the near term, and at least from a broader perspective, at least not put upward pressure on inflation, which clearly puts upward pressure on nominal yields. So in this next section, I wanted to take just a quick moment to discuss why we've gotten to this point of excessive fiscal spending. A lot of people think, well, it's because of COVID-19, but I think it was already happening, and COVID-19 brought the increase just forward. It was something that was already inevitable. In fact, I would say one of the biggest reasons is we've been engaging, even though fiscal spending has gone on and off since the great financial crisis, monetary policy has remained very, very robust, and it's just not working anymore. Like it's working, but we're getting diminishing returns. And I think one of the issues with that is that monetary policy, it's sort of a blunt force object, right? It doesn't address specific issues. It doesn't address things like structural reform, productivity, inequality. It just provides liquidity to those who can potentially get their hands on it. And governments, central bank heads knew this. I mean, Mario Draghi, who was previously the head of the ECB, European Central Bank, followed by Christine Lagarde, even before the COVID crisis, they were pushing governments to engage in more spending, especially types of spending that increase productivity. Jerome Powell was saying the same thing as well. So just to kind of show you the diminishing returns of monetary policy, I think it's pretty stunning. I think you all might be aware of this relationship as it is, but just to see it, I think is sort of interesting. So what we did right here was we calculated, we aggregated central bank balance sheets of the major central banks and looked at it as a share of G7 GDP. And so, I mean, just look at this exponential rise. The number was relatively low pre-global financial crisis, and then just look at this rise, astronomical, really, really big. And so what we did in this bottom box right here is we looked at, well, what are various measures of asset classes and the economy whenever the balance sheet has been at various levels? Because you would assume when the balance sheet is, really, really big and there's a lot of, monetary stimulus out there, it would have a much larger impact on the economy and inflation. And in turn, that didn't really happen. So, if you look at right here before the global financial crisis, real GDP gain per annum in the G7 was about 2.2%. In these interim periods, it ranged between 0.5 and 1.5%. So all of this rise in stimulus from here to here, this is the growth we got. Industrial production, not that great either. Disposable income, that's more of a toss-up. That didn't do so poorly. Inflation. I mean, I remember after the global financial crisis and central banks all over the world started stimulating, people thought we were going to see a surge in inflation. And in fact, all of this has actually seen inflation go at, almost half the pace of what it was before. Where we have seen a big increase is in asset prices. So if you look at house prices, this is before the global financial crisis. This is now over the past 5 or 6 years, so about the same. And one interesting thing about the COVID crisis is not just in the United States, but globally, they've bucked the trend, doing extraordinarily well. And then obviously global equities. So global equities have seen an enormous boon as a result of monetary policy, but in terms of impacting the US economy directly, not quite as much. So if fiscal policy, so now we've seen the diminishing returns in monetary policy, and the new future, and I'll talk a little more why I think that's the case, will be more fiscal policy. we have to make the best of it. So what types of fiscal policies can boost or reduce potential growth? And when I talk about potential growth, I don't talk about, oh, what's 1 year boost of stimulus. I'm talking about, increasing that long-term growth potential, that long-term average you go to. What are the things we can do to boost it? What are the things we can avoid? And just from the get-go, this is not an exhaustive list. There are many more things out there, and I'm just sort of stating a few examples. But the benefit of policies that boost potential growth is if we're right that interest rates will remain relatively low for an extended period of time, then we can engage in fiscal policies that boost potential growth, and that can help us grow out of the debt, because the debt is often shown as a share of GDP. So if we can grow our way out of the debt, we can even stabilize the number, reduce it just straight from the growth end. So here are a few examples. One, which I think has traction on both the left and the right, is infrastructure investment. It's sort of a win-win. When you look at infrastructure investment, it has one of the highest fiscal multipliers. So what I mean by that is when the infrastructure investment goes out there, you get the increase in spending from the government plus more. So it has sort of like a multiplied effect. So that's just great for the year in which it's implemented. But it also does boost productivity in the long term, and higher productivity leads to higher potential growth. So that's a good policy. Promoting innovation and technological change. This is something that's been in a downtrend in the US over the past few decades. In fact, in 1960, government research and development was 1.6% of GDP. Today, it's only 0.7%. So that could be a potential way to boost productivity. Also, promote competition, reduce barriers to entry, simplify taxes, sort of reform the tax system so you can simplify and now allow more entrants into the system that could potentially gain a competitive advantage. Reduce negative externalities. That's often what governments do. They tend to provide the goods that no one else wants to, that can give negative externalities. In terms of policies that could reduce potential growth, so reduce long-term growth, the existence of zombie companies. I mean, we saw this quite prevalently in Japan during the last decades. You could argue this could be going on in China right now, or even other parts of the world, because the stimulus this time around was, in many cases, untargeted. We wanted something very quick, so we put a lot out there. But when you have a lot of untargeted stimulus, it tends to go to companies that aren't as strong and maybe shouldn't have survived to begin with in a recession. So you're keeping them alive longer, and that could potentially reduce potential growth. Also, policies that reduce competition, such as increased trade barriers, rent seeking, corruption, those type of things. Policies that increase regulation, especially if it's regulation to protect a certain industry, that can also impede on potential growth. And then any sort of policies that downplay market forces. So if you want to nationalize everything, have what was private industry, now public industry and controlled by the government, sort of that command economy, that usually reduces potential growth, because the market does the best job of aligning supply and demand. So we should keep that in the hands of the market. Okay, so just in this final few thoughts, I think this is more of the bigger picture, which I think is pretty interesting, but perhaps could come off a little depressing to some of you. I just sort of wanted to step back and think about, why have we reached this point? So why have we reached this point of massive monetary and fiscal spending? I mean, the fiscal has kind of gone off and on over the past few years, but I mean, we can all agree it's definitely higher than what it used to be. And then no doubt the monetary spending is off the charts. We've never had to do this before. And to me, the cause is just low potential growth, sort of inevitable low potential growth that's being forced by poor demographics. I always talk about our demographic destiny. I mean, unless you're a really small populated country, it's really hard to change that dramatically in the long term. It's some of the best forecasts you can look at, or most accurate forecasts in the long term. And I think because of poor demographics and low potential growth, especially in the developed world, this includes the US, but I would say more so this is the case for Japan and Europe, is we are addicted to these growth rates that we had in the past. And we're stimulating like crazy to get back to what they used to be, but there's a possibility they're just not attainable. So we can just keep on throwing more money in, but it's not necessarily going to make a difference. And so if you look at this chart right here, this is a calculation of potential GDP growth in the developed world. It's the best possible growth we can have in the long term. It's where you tend to gravitate toward the mean. And so what you do is you add up the long-term growth in your inputs, so labor force, right? Plus productivity growth, how well you use it. And then right here, you get potential growth. Now it has gone down a bit because of the COVID crisis. It's at about 1%, but even before the COVID crisis, it was just a little over 1%. And that's 1% for an entire year. You go back to the late 80s, early 90s, it was 4%. So we're just growing. I mean, our best possible growth in the developed world is just a fraction of what it used to be. So we're throwing all of this money into the system, whether it be through monetary and fiscal, to try to achieve these really robust growth goals, but they're not really attainable. And a lot of it is demographics. I mean, holding all else constant, if you have fewer people making stuff, you're just not going to grow as quickly. And unfortunately, if you look at this next slide, that number is actually going to get worse for a lot of parts of the developed world. US, we're over here, we're actually not too bad. This is looking at working age population projections, so people age 15 to 64. In the United States, we have relatively high participation of people above the age of 65. We tend to work longer, so our number is actually even a little better. This is underestimating it. So US isn't quite so bad, but you look actually at quite a bit of emerging markets, but looking at the previous developed markets I mentioned, you have Germany, you have Japan, a few countries in Europe, and they're projected to see outright declines over the next decade or so in their working age population. Again, holding all else constant, if those people aren't working and they're not making stuff, that potential growth is going to be lower. And then, finally, the last comment I want to make about demographics, as Chris mentioned, I've done a lot of demographic work over the years, and I think it just explains so much of what's going on in the world. Demographics may also be the source of potential change going forward. You all may have seen, maybe not this chart in particular, but may have heard this stat, and if not, I'm perhaps introducing it to you, but in this 2020 election, the largest voting cohort is going to be millennials, right? They're now all of voting age. And, I think a lot of people don't realize, we always think, oh, the baby boom's a big generation, but the millennial generation is actually a little bit larger. So they're now going to be the largest voting cohort. Also coming up the pipeline is Gen Z. They will be able to vote for this election for the first time. They really weren't old enough to vote for the 2016 election, but they'll be able to vote this time and are going to be in growing numbers for subsequent elections going forward. And, if you look at these two age groups, they've really been bombarded by some pretty bad times, two horrible recessions, and a corresponding surge in inequality and a flatlining of wages despite higher levels of education. So, what's happening with these age groups is they typically tend to favor policies that promote equality and fairness, especially compared to their boomer parents. So to kind of give you an example, people often say, oh, well, when the young get older, they'll start to vote more conservatively. But, just to kind of give you an example, millennials today, look at that. They're not that young. Millennials today, not all, but in general, wanted Bernie Sanders in, they wanted Jeremy Corbyn in. Their boomer parents, when they were their age, were voting in Ronald Reagan and Margaret Thatcher. So very, very different views. So I think this change toward greater government spending was probably going to happen anyway. But the COVID-19 crisis, which sort of brought forward even greater so recession and inequality, will promote this bigger role of government going forward. So with that being said, I just want to kind of reiterate the main points. The first being the COVID crisis may have triggered an inevitable move to massive fiscal spending. if we're looking at, say, short to intermediate term, yes, the ballooning debt has consequences. It can be worrisome, but in this day and age, specifically for the US, we have more fiscal space, so it's not a near-term concern. And then finally, the big point I was making at the end, demographics is really the underlying cause and the big role behind the surge in overall stimulus over the past decade, and will likely be the source of change going forward. And with that, those are my prepared remarks, and I'm happy to address questions. I see a few right here. Do you want me to go ahead and touch on those, Chris? Does that work?
Yeah, that'd be great, Alejandra. There's a couple that popped in there, and then I had another one that was emailed.
Oh, okay, cool.
Why don't I go ahead and ask you the emailed ones first, and then we have a couple other that are streaming in right now as well. So first question is about your inflation outlook. I mean, we see on your charts that inflation has remained pretty tame with all the stimulus. What about going forward? Do you see inflation being a bigger part than it's played in the past?
I think, so I'll give you the reasons in a second. I don't think it's a near-term risk, but there are some recent changes that could potentially see it as a risk maybe 5 years down the road. First of all, I just want to mention, why have inflation pressures remained low for such a long period of time, especially over the past decade or two. And some of them I talked about in the presentation, low potential growth, right? If you can't grow very much, then the corresponding nominal inflation growth is just not going to be that high. You don't need as much inflation to support that growth. The high debt I mentioned. Another factor is just low inflation expectations. I think there's a general perception, at least within the developed world and even some parts of the emerging world, that central banks will keep inflation in check. We trust that, so we don't expect inflation to overshoot. Technology has been a big player as well, and also globalization. I have this one chart, I don't have it right here, but you'll see that since China joined the WTO in 2001, inflation pressures, core inflation pressures anyway, have remained pretty subdued for a long period of time. So, just because aggregate demand is relatively weak right now, I don't anticipate a big surge in inflation in the near term, but longer term, one potential risk is a decline in globalization. We were already seeing signs of that already as countries all over the world, see China as a threat. If we do potentially have a Biden presidency, we could see more of a multilateral approach that could be even more damaging. There's pros and cons. I'm not saying there's a good or bad, but it could potentially fuel inflation. And then also one thing the COVID crisis did do as well is, not only in the United States, but it pushed a lot of people to think, wow, I don't want to be dependent on the rest of the world if I go through a pandemic. I want to make sure I can take care of myself. So this has been a general perception in the US, but also in a lot of other countries around the world. They want to be a little more self-sufficient. So that's one change that we didn't have in the past that could be inflationary in the future once we get back to potential real GDP growth.
Okay, that's great. That makes a lot of sense. Another question we have is your thoughts on modern monetary theory.
Yeah. So that's, I don't know if all of our listeners are familiar with modern monetary theory, but it's become very popular over the past few years. It's a kind of a new form of economic thought. It may have gotten a little more say recently too, because Stephanie Kelton, she's not necessarily the creator of modern monetary theory, but she's one of the bigger promoters of it. And she was one of Bernie Sanders, I guess, consultants from the economic end. So she became, or at least the theory was brought to light quite a bit. Although what's interesting is if you look at the origins of modern monetary theory, even going back, I believe it started in the mid-90s, it has more libertarian views. So it's kind of interesting that it's latched on to the far left, but it could easily latch on to the right as well. But to kind of give you an idea, or just like a quick overview of what the theory implies, is that essentially the central banks lose their sovereignty to the government. So the government can pretty much spend all it wants, and the Fed can essentially fund all of it, or the Fed or whatever central bank can fund all of it. The only consequence that governments face is higher inflation. So if they stimulate too much, you get higher inflation. And according to the school of thought, the government would step in and fix the inflation problem. So it would be their job. It sounds like this is something that's happened a lot in the emerging world. So one of the caveats of modern monetary theory is it can usually just happen in very large developed economies, and the debt that you have, so the debt that you're issuing to try to pay everything off, needs to be denominated in local currency. So it limits to the number of countries that can possibly do it. Do I think modern monetary theory is a viable option? If you talk to most trained economists like myself, we usually say no. One of the main reasons is because we're stubborn. If you think about the study of economics, it's the study of scarcity, right? You can't have your cake and eat it too. Every decision, every upside also has an associated cost. The whole notion there's no such thing as a free lunch. That's exactly what our minds and our worlds revolve around. So when you get a theory like this, which is you can pretty much have your cake and eat it too, it blows up our minds. Like we can't handle it. I'm sort of joking, but it, to some extent, it does derail a lot of our framework of thinking. And many academic economists have sort of broken down the arguments, looking at their analysis of the ISLM curves, and have seen a lot of flaws in it as well. It doesn't really have, it's very simplistic. It doesn't take into account foreign markets as much. So really complex. But I think another reason it's gained a lot of traction is because you could argue it's been happening, right? So that chart I showed you where the government spent like crazy and we didn't see higher interest rates. I mean, that's pretty much the theory coming into fruition. In my view, as I talked about before in the presentation, I think we just have more fiscal space. There's a lot of other elements that are moving things back and forth. But let's just say the theory works. I think there's just a lot of flaws to it actually being put into action. The first being is that it solely puts all the decision making on governments. No checks and balances. You don't have an independent Fed that's trying to target long-term goals. They may not do it correctly, but at least they're trying to target long-term goals. You have it all in the hands of government. So are they going to use this fiscal spending to benefit certain industries that get them reelected? And I would say one of the biggest things that I mentioned before is governments are in charge of, under modern monetary theory, of combating inflation. So let's just say you see inflation pressures, you're going to get reelected in 6 months. Are you going to give a tax cut to the middle, or a tax increase to the middle class to cut inflation? I really don't see that happening. So assuming the theory works, I don't think it would actually. Assuming the background of the theory works, I don't think it would work in practice. And then to me, the other big downside of modern monetary theory is I think it takes for granted the position of the US dollar. So, we can kind of get away with this because we don't have that, as I showed you in that chart, looking at foreign exchange reserves, there's not a huge alternative to the US dollar. But, I would suspect if we were just to go overboard and, cut taxes to nothing, spend like crazy, I think over time, people would lose a lot of, faith in the US government, and we wouldn't be able to get away with this infinitely. So those are, in a nutshell, modern monetary theory and my thoughts on it.
Great. Well, we've got questions. We've got a couple more questions that came in. Alejandra, if you want to take 2 more off the screen there, and then we'll go ahead and wrap up for the day.
Oh yeah, I've been chatty today. Okay, so the first one, how much debt of other major countries does the US hold? So yeah, if we look at the total debt of other countries of US treasuries, I think it's somewhere, gosh, I maybe should have answered this one because I don't know off the top of my head, but somewhere around 25, 30%. So it's a pretty big chunk out there. So, if those entities were to lose faith in the US government, we could potentially see a pretty big decline in at least the demand side of treasury debt for sure. So hopefully that answers that. So that was kind of quicker. Okay, what are the implications to the US economy if the dollar is ever replaced as the standard currency? I think that's more a chicken and the egg, right? I think that's more of a consequence right? So if the US dollar is replaced as a standard currency, that would probably precede quite a bit of chaos in the US economy caused by, a wide array of factors. One of them, as I mentioned before, let's just say we were to adopt modern monetary theory as our way of, stimulating the economy, and we spend like crazy, and the rest of the world is like, well, you shouldn't be doing that. Then we could see very high inflation, no one investing in our country, because that's, one of the things we live on. People, even though we have a current account deficit, we have a capital account or financial account surplus. So a lot of money is invested in our country. We get a lot of money coming in because the US is a great place to do business. People know we do things well here. So I think, yeah, that if it were to be replaced, that would be the consequence of, bad policies leading into that. I don't see it happening anytime soon. And even just to kind of give you an example, I talked about it a little bit, because there's always been concerns, even before cryptocurrency, that the Chinese yuan, could potentially replace the US dollar as the world's most actively traded currency, just because of economic size. But to give you an idea, in the case of the United States, I believe we took over, so the pound sterling prior to the dollar was the world's most actively traded currency. But it took 40, so the US surpassed, the UK economy in size. I think it was probably the late 1800s, early 1900s, and it took 40 years for the US to supersede the pound sterling as the world's most actively traded currency. So, economic size makes a difference. But what happened 40 years after that was World War II. So often you need a very, very big event to ultimately trigger a big change in a global currency. So it takes a lot.
Great, that's perfect.
Great.
So thanks, Alejandra. We really appreciate you speaking today. It was a really interesting topic. Thanks to everybody who joined us, Venturi clients. We'll be doing more of these. You'll get invitations from us soon. If you had questions that were not answered, feel free to email or give us a call, and we'll reach out to Alejandra for those as well. Thanks, Alejandra.
Great. Thank you, everyone. Have a great weekend.